So let's dig in. The Borrowing Basics module will help you learn how to use credit appropriately and how to determine what forms of credit best suit your needs. By the end of this module, you will be able to define credit, explain why credit is important, identify 3 types of loans, identify the cost associated with getting a loan, tell how you are protected against discrimination in the lending process, identify the factors lenders use to make loan decisions, and explain why it is important to be wary of rent-to-own and refund anticipation services.
So let's get started and find out how much you might already know about this module that we'll be presenting today. So we're going to do a pre-assessment. If you would please turn to page 6 of your workbook, and we will go through these questions. And as we go through these questions, we'll give you a few seconds to choose your best answer, and then we will give you the answer to those questions. So we'll get started. What is credit? A, money you borrow and must pay back. B, free money that you do not have to pay back. C, money you have saved for emergencies. Or D, the balance left on a gift card after you have used it to pay for something. And the answer is A, money you borrow and must pay back.
Number 2, select all that apply. Maintaining good credit is important because it A, can help you graduate from college, B, allows you to carry more cash than usual, C, allows you to purchase large items like a car, house, or furniture and pay over time, or D, might cause your interest rates to be raised. And the answer is C, allows you to purchase large items like a car, house, or furniture and pay over time.
Number 3, what is a loan? A charge by financial institution for maintaining or servicing your loan account. B, money you borrow but must also repay. C, something valuable that you own and can sell for cash. Or D, the cost of borrowing money. And the correct answer is B, money you borrow but must also repay.
Number 4, which type of loan is used to pay for personal expenses for you and your family? Select all that apply. A, consumer installment loans. B, credit cards. C, home loans. And the answer is A and B, consumer installment loans and credit cards.
Number 5, a loan for which of the following is most likely to be unsecured? Select all that apply. A, a home. B, a car. C, furniture. And D, education or student loan. So a loan that is unsecured would be C, furniture, and education student loan.
Number 6, which of the following replaces a loan on your home in order to get a better interest rate? A, home equity loan. B, home equity line of credit. C, home refinance loan. Or D, a home purchase loan. And it's C, home refinance loan.
Number 7, what type of an interest rate stays the same? Would that be A, a fixed rate, B, a variable rate, C, a waning interest, or D, dual rate? Hopefully you get this one. It would be A, fixed rate.
Number 8, what should you review and compare when shopping for a loan? A, your annual percentage rate or APR. B, fees. C, truth in lending disclosures. Or D, all of the above. And you would be correct if you put D, all of the above.
Number 9, what 4 factors do lenders generally use in their loan-making decision? A, collateral, capacity, capital, and whether you purchase their credit protection insurance. B, capital, character, overdraft protection, and collateral. C, capacity, capital, collateral, and character. Or D, character, collateral, capacity, and credit line. The correct answer is C, capacity, capital, collateral, and character.
Number 10, getting credit is not cheap. However, which is usually the least expensive over time? A, rent-to-own services, B, a bank loan, C, a payday loan, or D, refund anticipation services? And the answer is B, a bank loan.
Number 11, a home equity loan replaces a mortgage at a lower interest rate. B, has the same monthly payment. C, is a loan designated for purchasing a house. Or D, can be used to pay for any kind of expense. And the correct answer is D, can be used to pay for any kind of expense.
Number 12, if someone offers you a loan, what can you do to make sure it is a good deal? A, check to make sure the loan provider is reputable. B, shop around and compare all terms and conditions. C, make sure you can afford the loan payments. Or D, all of the above. And yes, it's D, all of the above.
Number 13, which of the following is a short-term loan secured by your expected income tax refund? A, payday loans, B, rent-to-own services, or C, refund anticipation services? And the answer is C, refund anticipation services.
And number 14, the Equal Credit Opportunity Act, A, ensures you are not discriminated against because of your race, color, or gender. B, requires lenders to notify you if you are denied a loan or credit. Or C, requires creditors to promptly credit payments and correct billing mistakes. And the answer is A, ensures you are not discriminated against.
Okay, Stacy, let's look at this little cartoon. And we're going to see today through this program why possibly this was not a good idea that this happened. So we're going to start out. Hey, Ramon, check out this new cell phone I got. It has everything. It was a really great deal. I signed some papers, and I only have to pay $30 a month.
Do you know how long you have to keep it? And how can you pay for it? You always borrow money from me.
It's a $90 phone, so I'm sure I only have to pay for 3 months. And don't worry, bro. I got a student credit card.
So do you think Todd can afford the new purchase? What do you think might happen if Todd cannot pay his monthly cell phone or credit card bill? How might this affect his credit? So let's look at what credit is. Credit is the ability to borrow money. When you borrow money on credit, you get a loan. You make a promise to pay back the money you borrowed plus some extra. The extra amount is part of the cost of borrowing money. The cost is also called interest. If you use credit carefully, it can be useful to you. Not being careful in the way you use credit can cause problems. Having good credit means that you make your loan payments on time to repay the money you owe. If you have good credit record, it will be easier to borrow money in the future. However, if you have problems using credit responsibly, it will be harder to borrow money in the future. So why is credit important? It's important because it can be useful in times of emergencies. It's more convenient than carrying large amounts of cash. It allows you to make a larger purchase and pay for it over time. It can affect your ability to obtain employment, housing, and insurance based on how you manage it. So what is collateral? Lenders take a risk to lend you money. Therefore, they want to make sure that the money is secure and they get repaid. You will often hear loans referred to as either unsecured or secured by collateral or a guarantee. Credit is often secured. So collateral is security you provide the lender. You might pledge a car or sometimes your home. Certain items like the following generally cannot be used as collateral, such as furniture or clothing or kitchenware. A guarantee is a form of collateral. We also know this as a co-signer. So if you do not qualify for a loan, you might ask someone to co-sign on the loan. That means that if you do not make the loan payments to the bank as agreed, the co-signer must pay the money you borrowed plus the interest back to the bank. A secured loan is one where you're pledged collateral to repay the loan. Home equity loans and loans to purchase a car are two common examples. An unsecured loan is not backed by collateral. Personal and student loans and credit cards are examples of this. So let's look at types of loans. Credit cards. Credit cards give you the ongoing ability to borrow money for your household, family, and other personal expenses. Having a credit card allows you to buy things without actually having the money right away. So remember that if you're not careful in spending, you can get into big trouble. You could be burdened with debt. You need to be sure you are able to make at least the minimum monthly payment on a credit card bill. Ideally, though, you will pay more of the bill in each month to avoid paying costly interest to the lender. So consumer installment loans. These loans are used to buy personal items for you and your family. It's called an installment loan because you pay the same amount each month in installments. One of the most common types of installment loans is a loan to purchase a car. When you need to borrow money for a larger purchase, there are certain advantages of borrowing through an installment loan instead of through a credit card or rent-to-own service. You're aware of the monthly payment amount and the time period given up off the loan. Installment loans, especially when secured by collateral, generally have much lower rates, so it costs you less money. Repaying an installment loan includes principal and interest according to a present payment schedule. This reduces the original loan balance during the term of the loan. So let's take a look at Activity 1 in your workbook, page 12. We're going to look at installment loans versus rent-to-own services. So consumer installment loans. These are secured installment loans are loans that are repaid to equal monthly payments for a specific period and are secured by the item you purchased. You can use the item you purchased while you are paying for it.
The rent-to-own services, though, a rent-to-own service allows you to use an item while you make weekly or monthly payments on that item. When renting or leasing the item, you do not have to purchase the item and can return it at the end of the term. If you decide to purchase the item, the store may give you a price to buy the item and set up a plan to apply weekly rental payments toward the purchase price. The store is the legal owner, though, of that item until you make the final payment. And if you miss a payment, then the rent-to-own service has the ability to come back and repossess that property from you.
With installment loans, you are charged interest and you can shop for the best deal comparing APRs.
On the rent-to-own service, though, rent-to-own agreements are technically not loans. So no interest is charged and often no credit check is performed. However, the fees included in your rental payment are just like interest you would pay on a loan.
And generally, installment loans are less expensive than rent-to-own agreements.
Rent-to-own, by making the weekly payments, you will pay much more than if you had paid cash or you'd used an installment loan. So really trying to understand the difference between consumer installment loans and rent-to-own. Rent-to-own, they don't pull credit. It doesn't increase your credit. They can repossess if you fail on making the payments. So good idea to really pay attention when you're making purchases, to pay attention to those rent-to-own services. They can be very, very challenging, and you can lose all the money as well as the property if you miss a payment.
So let's take a look at this scenario with Grace. Grace is moving into her own apartment after graduation and wants to buy a television. She is trying to decide between getting an installment loan and using a rent-to-own service for the larger purchase. A local electronics store was selling the television for $1,500. A nearby rent-to-own store advertised the same model for $55 every other week. After seeing the advertisement, Grace went to the rent-to-own store to get more details. The manager told Grace she would own the television in 52 payments for 2 years. Grace multiplied 55 times 52 weeks, and she got $2,860. Grace also found that if she misses one payment, the rent-to-own service will take the television back. If she makes 50 payments on time, 50 times 55 is $2,750, and misses payment 51, she loses the television and is out $2,750. The manager told Grace that with rent-to-own services, she could return the television with no obligation. Grace did another quick calculation. If she uses the rent-to-own company and returned the television after a year, she would pay $1,430, so 26 weeks times 55. Help Grace decide which option is better, the rent-to-own service or an installment loan.
So when we look at these options, Stacy, one of the things that really stands out to me between these two options for Grace would be the fact that if she uses this consumer loan, she will build credit.
She also will have a cost savings.
With the consumer loan, she also would have no hidden fees.
And she would also have no loss of purchase.
So with the credit card, she can shop for the best deal with the best rate. So when we look at this scenario, very definitely based on the information that was provided in this scenario, the consumer installment loan or credit card would be the best deal for Grace on this option for her television.
All right, let's move into home loans. The third type of loan is a home loan. There are three main types of home loans. There's a home purchase loan, a home refinance loan, and a home equity loan. All three loans are based on the value of your home. The home purchase loans are made for the purpose of buying a house. They are usually called mortgages. Home refinancing is a process by which an existing home loan is paid off and replaced with a new loan. Homeowners often refinance their home loans for a lower interest rate. Home equity loans can be used for any reason. The amount that a person can borrow depends on the amount of equity they have in their house. In general, the best uses for home equity loans are to purchase goods or services with long-term benefits.
I want to mention that I want to share just a quick story about the reason to do a purchase on a home loan. I know that we've talked in the other modules about some investment ideas. And so I do want to share that my middle son, who will be 40 this year, purchased his first house at 25. So he was young, made a purchase of his first home. Wasn't the dream home by any means, but it was definitely some home ownership. He has now been married for 9 years. That home he sold. Him and his wife built a new home when they got married 9 years ago. So when he sold the house, he actually, when he moved out of the first home, he used it as rental property. And so the people that were renting after several years decided to purchase the home. So he sold that house and then took those funds and put it against his existing house. So at this point, at 40, he has bought and sold a home, used some of that money for investing, and after 9 years, almost has his big home that him and his wife built sold. So when we talk about, or paid for, I'm sorry. So when we talk about investment and some of these options and talking about home loans, it's really important to really take a look at maybe that first home is not where you want to be forever, but what a great investment over time. A purchase at 25 and now almost at 40, and he has a very large home that's almost paid for. So just think about those kind of scenarios as well. Stacy, what about activity number 2, right?
Page 14 of your workbook. So we're going to fill in the blank with the most appropriate loan type for that purchase. So number 1, go ahead, Ter.
To finance a college education, would that be a consumer installment loan, a credit card, or a home loan, either a purchase, refinance, or equity? The answer to this one would be consumer or an equity loan for your college education.
To make a small purchase in a department store, would that be consumer, credit card, or home loan? And this one would be a credit card.
How about to make larger home improvements? Consumer installment, credit card, or home loan? For home improvements, you would look at a home equity loan.
If you wanted to consolidate debt, would you do consumer, a credit card, or a home loan? And to consolidate debt, you could either do a home equity loan or a consumer loan. So let's look at the cost of credit. Fees. These charges for activities, reviewing your loan application and servicing the account. Interest is a charge for using financial institutions' money. There's fixed rates or variable rates. Your truth in lending disclosures, The Federal Truth in Lending Act requires banks to disclose charges so you can compare the actual cost of borrowing. Lenders must disclose the amount financed, your annual percentage rate, finance charges, and total payment. Borrowing money responsibly. We're going to look at activity number 3 in our workbook, page 16. So we're going to answer each of the following questions. Terry, you want to take number 1?
Absolutely. What questions should you ask yourself before you decide to apply for credit? So let's think through that. Probably the first thing that you consider is, do you really need it? Or can you wait till you actually have the money to pay for that item? Can you afford the payment? Do you have enough funds to make a payment if you were to put that on a credit card or some sort of a consumer loan? Can you get credit? Do you either have good credit already or do you have no credit? And we'll talk about that later on in our presentation as well. And how much will it end up costing you if in fact you decide to apply for credit?
So would you use credit to pay overdue bills? Why? No. You're just going to be adding to the problem if you do this. You need to reduce your spending and negotiate with your creditors to see if they can help.
We did talk about that a little bit in a previous module, that if you get in a pinch and you're not able to pay your overdue bills, get with your creditor right away and see if they can work out a payment plan. But to get additional credit to help pay for overdue items is not a good idea. So great answer, Stacy. If you're trying to establish credit history, would you use credit to make a purchase even if you have cash that could pay for it? And if so, why? This is actually yes, and the reason is that this will help you to establish credit, but please make sure that you're wise with that credit. And we'll talk about those scenarios coming up as well. So yes, to establish credit history, sometimes you will need to apply for a credit card, and we'll talk about that a little bit more.
Number 4, would you use credit if you really wanted something but could not afford the monthly payment? No. Only use when necessary and you are able to make the payment, such as like if your car breaks down or if you need new tires on it. This could actually hurt you in the long run. Let's take a look at the Equal Credit Opportunity Act. This act prohibits discrimination during the loan application process, restricts the lenders from requesting certain information, and requires the lender to notify you in writing within 30 days if you have been approved or denied on the loan.
So now let's take a look at page 17 of your workbook. We're going to start digging into the items that are very important. We call them the 4 C's of credit, that are important pieces for us to discuss today about what the creditor looks for when they are anticipating maybe approving you for a loan. So those 4 C's are capacity, character, collateral, and capital. And so now we'll go into detail and talk about those in a little bit more detail. So capacity refers to the ability for you to be able to meet those payments. So when a lender is looking at your capacity to make the payments, they're going to look at how long you've been working at your job. How much money do you have each month that you're bringing home? How much income do you have? And then what are your current monthly expenses? So definitely a lender is going to look at your capacity, making sure that you're probably working, that you have some money, enough money to make the payments, and then what your expenses are for the month. They're also going to look at capital, and this refers to the value of your assets and net worth. So they're going to look at how much money you might have in your checking and savings account, and if you have any investments like stocks or bonds or other assets, maybe a car, maybe it's a home. So those are the things that the lender's going to look for as well, is your capital, what kind of assets you have, and your net worth. Another item they're going to look at is your character. And this refers to how you pay your bills or debts in the past. So have you had credit in the past? How many credit accounts do you have? And we'll talk about that today too. You should really limit the number of credit accounts that you have. Have you ever filed for bankruptcy? had property repossessed, or made late payments. And character is a huge piece that the lender will look at to make sure that are you a good risk to the lender to make that loan. On page 18, it also talks about the free annual credit report. And so every consumer has the ability to get a free credit report. It's a really good idea to get that free credit report so you can just kind of stay on top of making sure that nobody's using your credit, making sure that you don't have any items that are reported on your credit bureau that maybe aren't yours. And we'll talk a little bit about how to get those off if you needed to, if that was happening. It's a great idea to do that. I know a lot of credit cards these days also have the ability that you can look at your FICO scores, and we'll talk about that today too. But even though that gives you what your FICO score is, it's really a good idea to get your free annual credit report so you can just see what's left on your credit. The last of the 4 C's is collateral, and this is another really important piece that the lender is going to look at. And it refers to the property and assets used to secure the loan. So do you have assets to secure the loan beyond your capacity to pay it off? And so what that really means is if you're purchasing a car, for instance, and they're going to obviously use that car as security, but they want to make sure that the lender doesn't want the car back. I promise. The goal of a loan isn't for them to give a loan to you and then repossess your Honda Civic. The goal is really to make sure that you have good collateral, good character, you have the ability to repay that loan, and just making sure that you'll be able to do that. So collateral is definitely what the lender is looking at, that they're going to hold title work for, most likely, the car, in order to make sure that you're making those payments on time so that they don't have to come back and repossess that item. Let's take a look at workbook page number 19. So we're going to talk about some of the barriers to borrowing money. So if you've made late payments, that's going to affect your credit. If you filed for bankruptcy, it's going to hit a hard knock on your credit. Having property repossessed or foreclosed on because you couldn't make the payments. And sometimes things are going to happen in life where maybe you do lose your job and your property is repossessed and foreclosed on. Those are going to be items that you can probably explain to a lender, but it still is a hard hit on your credit for sure. And then having a court order requiring you to pay money back to a lender. So these are barriers to borrowing money. These are going to be items that if a lender sees these things, they're probably going to ask you some questions about them and why these things happened. We can talk about legal terms on page 20. So legal terms for debt action. We're going to go ahead and talk a little bit in detail about those items. So an attachment is a lien against your personal property. Bankruptcy is a legal decision of insolvency. And so that means that it usually stays on your credit for about 10 years. And that's a long time on your credit report because it really takes a big hit on your credit when you have a bankruptcy. Collection account. Past due accounts where they've put a collection in place where they're going to collect that debt from you. Foreclosure is another legal proceeding initiated by the lender to take possession of your property or your collateral. Garnishment. This is where the lender obtains from a third party the ability to garnish some of the salary from your employer. And so they'll send this information to your employer, to your HR department, and then they are required to pull those funds out from your check. And so until you get that paid off, that garnishment is going to stay in place. A judgment is a court order requiring the debtor to pay money back to the lender. And they could place security liens on your property. And again, it's going to be a very negative piece to your credit. A lien is a lender's claim against your property to secure repayment. And then, of course, repossession is where they do seizure on your collateral and come and take that back. So next, Stacy, let's look at activity 4 in the workbook on page 20. So we're going to read these scenarios and talk a little bit about these items. And forgive me, I got myself just a little bit out of order here. So number 1 is consistently making late payments Jeremy bought a cell phone because he works late at the movie theater on weekends. At first, he made all of his payments on time. However, he had to quit his job because he had trouble in school and needed more time to study. He signed a 1-year contract and is having difficulty making his payments. He has made late payments for the last 3 months. So of the 4 C's, capital, collateral, character, and capacity, what do you think is going to be affecting this decision and this scenario that has happened to Jeremy? One of them is capacity because he's no longer working. And then the second is character. It's affecting his character because now he's making late payments.
So number 2, filing for bankruptcy. Jeremy's older brother, who was in college, applied for and received several credit cards. He maxed out, met his credit limit on all of the credit cards, and then he could not afford to make the payments. He filed for bankruptcy, which shows lenders his inability to manage money and pay bills. So which of the 4 C's is this going to affect? This is going to affect his character.
Next, we have not enough assets. So Joe wants to buy a house. He does have a job, and the house will be collateral for the loan. However, Joe does not have enough money in his checking and savings account to reassure the lender that after closing, he will have enough funds to make payments or home repairs in an emergency. Which of the 4 C's would this affect? This would affect capital.
Number 4, no credit history. Sarita wants to apply for a credit card. She is in college and does not have a regular income. She also has no credit history. Therefore, she will need to ask her mother and father to co-sign on the loan. So which of the 4 C's does this affect? And this is actually all 4 C's: capital, collateral, character, and capacity.
Okay, Stacy, let's take a look at a loan application. So in the workbook, you are going to be on page 22. We're going to take a look at how to complete an application and talk specifically about what the 4 C's, these areas on this application. So the first part is employment information. And so this is going to have name and address of your employer, position, title with the company, the name and address of you and them, and the position. If you've had multiple jobs, you're going to list multiple items on this credit report. You're going to list the dates, monthly income, phone numbers, and a business phone number. So this particular information on the application is capacity, the ability for you to pay back that money based on your employer or employers and how much monthly income you have from those jobs.
So number 2, the monthly income and combined housing expense information. This is where you're going to list how much money you make, and you can break that down. They'll want to know bonuses, commissions, overtime, etc. They'll also want to know how much rent you're paying and any other liabilities you have, such as credit cards. This is going to be your capacity.
Next, number 3 is the declarations. So this is where you're going to actually answer for the borrower. And you'll also see on this area that there's a borrower, yes and no, and a co-borrower. So if in fact you have a co-signer, somebody that's going to sign jointly with you on the application, both would need to answer yes and no's. So they're going to look for any outstanding judgments. You're going to answer yes or no. Have you declared bankruptcy in the last 7 years? And remember, even though it stays on your credit for 10 years, they're just asking, have you filed in the last 7 years? Have you had property repossessed in the last 7 years? Are you party to a lawsuit? Have you directly or indirectly been obligated on any other loans with anyone else? So just make sure that you need to be honest with answering these, because when they pull your credit report and look into that, they're going to see if you've had repossessions or judgments or bankruptcy. So just make sure that you answer them honestly. And then you can speak to them if there was a reason behind some of those issues on your credit. And this one would be, of the 4 C's, is referring back to your character.
Number 4 is your assets and liabilities. This is where it's going to get more detailed, so we can break down if you have car loans, credit cards, that type of stuff. This is capital and collateral.
So next on the credit report, we're going to talk a little bit more in detail about that. And so a credit report tells the lender a lot of information: who you are, how much debt you might have, whether you've made your payments on time, and whether there is negative information about you in public records. There are three major credit reporting agencies that most lenders use, and that's Equifax, Experian, and TransUnion. Many times when we talk about FICO scores today, when you actually look at your credit report, you might see that there might be a little variance between some of those scores on those credit bureaus, and that's because some of them weigh things a little bit different in their reporting, but they're usually very accurate, and still the lender uses that as a reason to either approve or decline your loan. So these agencies, so the three major credit reports, they receive this information from other lenders or credit card companies and those areas that you've borrowed money from. They collect this information about bankruptcies and judgments and tax liens and all of that information, and they input it into their systems. And while each credit reporting agency may have a little different format, just like I mentioned a minute ago, they're all still looking at basically the same information. Personal or consumer information, which is your name, address, and employment. Personal or consumer statement, if you submit a statement to the credit reporting agencies to be included in your credit report, and you can do that. Account summary kind of gives an account overview of your credit information, account status, account history, how long you've had credit with that specific entity. Inquiries that have been made for your credit history. So when a creditor is looking at the credit report, they're going to see if you've applied for credit at other places, and that can be another hit on your credit report. So be very cautious of that. If you're looking to buy a car and you go to 4 car lots and each time they're going to pull your credit, that's really going to take a hit on your credit, and the lender is going to question, I saw you were just over at Toyota, and now you were at Stradley, and now you're over here. So just be really careful with those kind of things too. And then again, public record information, tax liens and bankruptcies and those kind of things. Let's jump over now to page number 25, and this is going to be activity 6 on our agenda today. So first off, there's a sample credit report on this page, and we're going to refer to that sample as we look to answer the questions on page 26. So just kind of generally on this credit report, you can see that the first area kind of has the personal information on it, along with the employer. There's a consumer statement on here. Any negative items are in area number 3. And number 4 has any areas that you may have applied for additional credit history with other agencies or entities. So when we look at page 26, we're going to start out with looking at this credit report. And the first question says, John Consumer has an account that has been sent to a collection agency. Where on the credit report would you find this information? So as you look at the bottom of page 25 and the top of page 26, we're trying to find out where is on the credit report is that negative information. I hope that you can see it on the bottom of page 25. So it's the potentially negative items, and those are listed right there. And you can see that it has a delinquency date. It's been in collection for 120 plus days. It shows the date that it was actually filed, and then the account number tied to that cable.
And number 2 is asking us who the original creditor is. And again, we're going to look in that same box under the potentially negative items, and it's going to tell us that the original creditor is Televised Cable Communications.
On number 3, it says in August of 2004, an account was closed at John's request. What was the highest balance on that account? So in that area, you're going to look at the top of page 26, And you're going to see that in the accounts in good standing. On the right-hand column, you're going to see that there's a status, and it's dated 4/3 of 2000, and it's saying that it was closed at the consumer's request on 8/22 of 2004. Sorry about that. And the high balance was $3,228. So John might have decided that he wanted to close that and not use that that credit card or credit services anymore, and he asked to have it closed out. And those kind of things are going to show on your credit report.
And number 4 is asking us where we found that information. And again, that's in your accounts in good standing section of your credit report.
And we've talked about this before as well. So who does John work for? Where did you find this information? So again, on the credit reports, it's going to show where you worked, and it's going to give some history on employers. So for that area, you're going to find the answer on page 25 in the right-hand column, and it's listed under employers. So it's ABCDE Engineering Corp is listed as his employer. So let's talk about some tips for building credit, Stacy. Just giving everybody kind of an idea on some things that might help you along the way when you're trying to build a credit history or demonstrate your credit worthiness. So one of the things is to make regular deposits into a savings account. And I know we talked a little bit about this in the previous modules. It's really important, and a lender will look at that, because if you have some money in savings, and say for instance you got, had to buy tires for your car or some larger expense, if you have a little bit of money in savings, the lender is going to feel comfortable that you save some money for any unexpected expenses.
Paying all of your bills on time. This will help you establish good credit history so you can get credit in the future. Not paying any bills you receive can harm your credit. And again, what we talked about before, if you get yourself in trouble, make sure that you're asking someone to help you, an adult, or calling those companies and seeing that they'll be willing to work with you.
Apply for a small loan at the bank or credit union where you have your checking and savings account. That can help start building your credit, and making sure that you have a savings or maybe a certificate of deposit. This reduces the lender's risk, but it enables to show that you are have good history and able to save and probably making your payments on time. So applying for a small loan can also help build your credit.
Applying for credit with a local store, they typically have lower credit limits with a higher APR, but they are generally more willing to lend you money.
Make a large down payment on a purchase. So as you have some savings, you might have the ability to maybe negotiate with your lender or your the person that maybe you're trying to buy a car. So for example, if you're buying a used car for $5,000 and you have enough cash, you might consider maybe putting down $1,000 or $3,000. Although the loan will be very small, it can still help build your credit.
Asking a friend or relative with an established credit history to be a cosigner for you. A cosigner promises to repay the loan if you do not. Just keep in mind that this can damage the cosigner's credit history as well as yours if you do not pay the loan back as promised.
And here's a really good one as well, is to keep your debts low. The more debt you have in relationship to your income, the less of it, or the more available credit lines you might have will be viewed by the lender as a high risk. So if you have lots of credit cards, even if you're not using them, the ability that you could go out and just charge up all those credit cards is going to scare a lender a little bit, wondering why you have all those. So make sure that all your monthly obligations are paid. And here's a really good tip. Those obligations should be less than or equal to 33 to 36% of your monthly gross income. So make sure that you understand that any bills that you have and the income you have, try to keep those down below 35% of your income, because the lender is going to look at that as a way to gauge, do you have the ability to pay this if something unexpected happens?
Consider a no or low fee secured credit card. If you cannot qualify for a regular credit card, secured credit cards require you to keep cash in a deposit account. Your credit limit would be based on the amount of cash you have in the deposit account.
Secured credit cards are really a good way to even establish credit. I have helped many students do a secure credit card where they had a savings account, and so they secured it with their own $500. So they use that card very wisely and then pay it off monthly, because that's really the goal. Remember, just try to use it very limit that spending, maybe get gas with it, and then pay it off at the end of the month. And after a year, most of the time, those credit card companies will then put you into a regular credit card, and then your money won't be secured anymore for that credit card. So just a good idea that if you're looking for a way to get started with some credit, a secured credit card is a great way to make that happen. So let's talk about some of the catchphrases, and I really want you to listen to this piece, because there are some predatory lenders out there that may prey on you through time, and you just want to make sure that you don't feel pressured, and if you hear any of these phrases, you definitely want to make sure that you're paying attention to that. So some of the catchphrases on page 28 of your workbook is they want to lend you up to 125% of your home or your car's value. Let me tell you why that's a really bad idea. That means that if your car is $5,000 and they lend you 125% of that, which is going to be over what the value of the car is, and say, for instance, you wreck that car, you're still liable for that loan, and your insurance is only going to pay you for the value of that item. So anytime somebody says, "Oh, don't worry, we could give you up to 125% of the value," just walk away, because that's not a good idea. Another one is incredibly low payments, and this is another way of them just getting you to do payments for a really long time. So they may tell you that it's only going to be $100 a month, but maybe what they forget to tell you, it's for the next 25 years. So make sure that you're really paying attention to that. If they say, "We can get you in this car," and I've heard this, "I can get you in this car for $100 a month," you need to ask, "And how long is that for?" Another catchphrase that you need to pay attention to. How about no upfront fees? So there might not be any upfront fees, but what does the interest rate look like? And making sure that what you're really borrowing for, and what is it going to be for over the life of the loan. This one is another one. Even if you have bad credit history, I can get you into this loan. So again, they're going to target those people that maybe have some challenging credit, and maybe they don't have the money really to buy this item, and they're going to convince them that to go ahead and get this item, and then probably they're going to repo it. So really make sure that, even if you have bad credit history, just over time, save your money, build your credit back up, get yourself back on track, and don't get into a situation where they're telling you it doesn't matter what your credit is, because it does matter what your credit is. How about it is free and you have nothing to lose? Again, another just one of those clues to look for. Might be free, but is there really any hidden fees in there? And what does that rate look like for me? Act now. It's a limited time. This is one of those areas where they're really trying to pressure you into just getting that loan or making that purchase. And you can walk away and just think about it, because you don't want to get yourself again into a situation that later you think, "Oh, I should have never did this." So if you ever hear even that term, you need to just try to walk away. When we talk about predatory lending practices, to guard against them, make sure that you deal with reputable loan providers. There are a lot of lending companies out there that are, high rate and low payment, and like I said, your payments may go on forever and ever. So make sure that you use a reputable loan providers. Shop around to obtain the best rate and terms, and we're going to talk about that today too. Read and understand all the terms and conditions. All that fine print in those contracts, it's really there for a reason, and you should be paying attention to it and making sure you understand it. Don't just tell them. Many times I have seen where a lender will just slide the papers across the desk and say, "Hey, just go ahead and sign right here." Never ever do that. You need to make sure that you understand what you're signing. So read and understand the conditions and the terms. And again, make sure that you can afford to make those payments according to the loan terms that lender has given you. On workbook page 30 and 31, let's talk a little bit about the rent to own. And, there's payday loans and refund anticipation services. They're out there to help people that might have some challenges in their life right now. And I'm not ever saying that you shouldn't use them, but just be very leery about using those. So when we take a look at those, when we talk about rent to own services, this allows you to use the item while you make payments or weekly payments, monthly or weekly. But remember, the store still owns that item. And if you don't get yourself all the way to that final payment, they can come and repossess that item. And you don't get any of that money back. So really be cautious of those. And generally, like Stacy and I talked about earlier, they're more expensive than a consumer loan would have been. When we talk about payday loans, so these are another very challenging area. I can tell you, though, over time, payday loans have now finally got some really good guidelines, and the government is really working with those short-term loans, if you will, to make sure that they're not taking advantage of those consumers. So these are usually a short-term loan for 2 weeks, a $30 fee. So you write them a check for $200. They hold it for 2 weeks, and then they push it through your account for the $230. So just pay attention. Payday loans are another one that I hope you don't have to do. Refund anticipation loans. So this is a loan where, it's a short term. It's based on your expected income tax refund, and it's secured by that. And usually it's electronically filed so that the lender knows that he's going to get paid back. So just be leery of these and making sure you understand what the fees are and how that actually works, because these are, again, just an area to be cautious of as well. All right, Stacy, I think, we already talked about these. Oh, I know. I'm sorry. Oh, I'm so sorry. I just got kind of caught up in this. Okay. So, Stacy, let's talk about tips for borrowing money again and how to be smart about it. So, here's what I recommend. These are the things I would like you to make sure that you do. Pay your bills on time to build good credit history. Make sure your credit history is correct by reviewing your annual credit report. Be an informed consumer. Make sure to shop around for the best deal. If a creditor is not willing to give you information to compare, you probably don't want to do business with them. Ask friends, family, and credit counselors for advice. Take somebody along with you if you're just not sure when you're talking to the lender. That way there's two of you to kind of ask questions and make sure you understand everything. Take your time before deciding on the loan or the lender. Like I said, it's okay to walk away. And then make sure that you just think about it before you actually sign the paperwork. Don't get caught up on, this fancy car that you really maybe can't afford. And then be careful of lenders who will tell you that that they do not care about your credit history, because they do. They're trying to take advantage of you. So be really, really cautious with that as well.
So the do nots of borrowing money: do not let lenders pressure you into decision before you're ready. Do not respond to advertisements that make lending sound cheap and easy. And do not respond to offers to refinance your loan shortly after you just refinanced it. Make sure you really need the loan, or the loan makes economic sense for you. If it's too good to be true, it probably is.
Okay, Stacy. Looks like we have a cartoon again. Let's see what happened with that cell phone that we had discussion on earlier.
How's that new cell phone?
I shouldn't have bought it. It was really dumb.
How come?
The phone calls are really expensive, and I signed a year-long contract that I can't get out of without paying lots of money. I just got too excited. I should have been more careful. So here's a perfect example of just waiting it out, making sure that, it looks like Todd just got caught up in the moment with his cell phone, and look what happened. Now he's really struggling to make the payment. So really be cautious with that for sure. So congratulations, we have completed the module. So we hope that you learn credit and what good credit means, the different types of loans, the cost of credit and the cost of using non-loan services, and how lenders make good credit decisions. So let's do a real quick knowledge check on what you did learn today. In your workbook on page 33, let's take a look at what you learned. Number 1, if you buy something on credit, you must pay back the amount you borrowed. A, all at once, B, plus interest, C, according to the credit terms, or D, B, and C. The answer is B and C, plus interest and according to the credit terms.
Number 2, a loan is the amount of money a financial institution charges for allowing you to use its money. Is this true or false? And this would be B, false.
Number 3, the 3 main types of loans are consumer installment loans, credit cards, and home loans, or D, all of the above. I'm sure you got this right because we talked about all 3 of those today. D is all of the above.
Number 4, what is used as collateral for a home loan? A, the home, B, the furniture or furnishings, C, personal assets, or D, all of the above. And you would be right if you picked A, the home.
Number 5, which of the following is an example of a secured loan? A, home loans and home equity loans, B, most credit cards, C, personal loans, or D, student loans. Remember, a secured loan means that you have something secured for that loan. So your answer would be A, home loans and home equity loans.
Number 6, which type of interest rate can change during the term loan? A, fixed interest rate, B, variable interest rate, and you would be right if you guessed B, variable interest rate.
Number 7, which of the following must be included in the truth in lending disclosure? A, the amount financed, B, APR, C, finance charge, and D, total of payments. I hope you remember when we talked about this today, that would be all of the above. How much is financed, what the rate is, the finance charge, and the total amount of payments.
Number 8, lenders will review the 4 C's to determine whether you are a good credit risk. Which of the following refers to property or assets offered to secure the loan? A, capacity, B, collateral, C, capital, or D, character? And the answer is B, collateral.
Number 9, which of the following information is included in your credit report? Select all that apply. A, a list of inquiries for your credit report. B, personal identifying information. C, credit history of your accounts. And then D, public information, or E, all of the above. I hope you remember when we reviewed the credit report, it would be E, all of the above.
Number 10, you must be careful of rent-to-own services, payday loans, and refund anticipation loans because they often cost more than an installment loan. Is this true or false? And yes, it's true.
Number 11, an installment loan is A, always has changing interest rates. B, generally has the same payment every month. C, can be used like a check. Or D, is the same as rent-to-own agreements. The answer would be B, generally has the same payment every month.
Number 12, why is credit important? A, it allows you to make a large purchase and pay for it over time. B, it can be useful in times of emergencies. C, it is more convenient and safer than carrying large amounts of cash. Or D, all of these. And yes, it's D, all of the above.
Number 13, which of the following let you use an item for a period of time by making monthly or weekly payments? A, payday loans, B, rent-to-own services, or C, refund anticipation services. hope you remember that it was B, rent-to-own services.
Number 14. Which act ensures you are not discriminated against because of your race, color, or gender? A, the Equal Credit Opportunity Act. B, the Fair Credit Reporting Act. C, the Truth in Lending Act. Or D, all of the above. And this is A, the Equal Credit Opportunity Act.
Thank you again for attending today's FDIC Borrowing Basics presented by Bank of the San Juans.